Hey, it's Jordan with Cashflow AI, and I'm going to talk about how I would start trading back again with $10,000 trading options with a simple, consistent, and low risk income. Now, if you don't know anything about me, I've been trading for 8 years. I've tried everything, moving averages, RSI, MACD, you name it. And what I found works best, especially for a 10K account, is simple options selling. That's exactly what I would do. And so here's a breakdown of the strategy that I would look to do. And I'm going to dive into this a little bit further. But 60% of the trades I would look to do zero DTE credit spreads. 30% I would look to do next day Iron Condors or credit spreads. And then 10% of the time I would look to be doing Iron Butterflies. And this is all based around options selling. And so why even sell options? Well, I was buying options for the first 4 or 5 years that I was trading, and it's terrible. It's super hard. You have to be right on direction and time. Versus selling options, your decay or the time decay of those options is your actual edge. You have much higher win rates. You have defined risk. You can do it in any market. You can do it with 10K, and you can get daily or next day income, which I love about it. And so as an example of a credit spread, this is what one would look like. So let's say the SPX is at 5,800, and you can do this across a lot of different stocks. Let's say SPX is at 5,800. What you can do is sell a put. So for example, a 5750 put at the strike price there. And then you can buy another put, and that's going to put a spread. So when you're buying one option and then you're selling another, you're going to get that spread. And so what that is you're going to get a net credit. So instead of buying options and costing you $100, you're actually going to get paid $100 for taking on this trade. And you obviously can't just take that money and run because the option needs to expire worthless or the spread for you to profit on that. But nonetheless, it makes the trade extremely simple. If I'm selling the 575 put and I'm buying the 5700 put, and I get a net credit of $100, it's a very simple trade. For me to make this $100, all I need is for price to close above 5750 by the end of the day. And I'm going to make $100. And my max profit is 100, my max loss is 4,900. And the big thing about this too is max loss doesn't mean you're going to lose every time, okay? You always use stop losses on your trade, so it's not like you're risking 4,900 if you don't have a stop loss in place. So we always use them to make sure our risk reward is a lot better. Now, why zero DTE and why or next day, 1 day expiration options? Well, time decay accelerates, and this is a chart of what can look like, and typically you can see this is a compounding chart. So it starts off basically straight horizontal for the first 2 weeks from that 30-day expiration point. The 7 days start to taper, and really down at zero DTE is when this thing starts to drop, because really it's kind of like a curve where all exponential decay movement happens at the very last day or last 2 days. So the advantage is trading zero DTE or 1 day to expiration. You get extreme theta decay, same day results, very high probability, and you can use good risk management. And as long as you're managing risk, you're going to be okay. Even though a fast move can hurt, as long as you're managing risk, you're going to be okay. And so the other kind of strategy I would do is an Iron Condor next day strategy. And so Iron Condor is a strategy where you're putting on 2 spreads on each side, so a put spread and a call spread. And basically what you're doing is you're saying, I'm going to expect price to stay within a certain zone or stay pretty neutral. So let's say you did a put spread at the 5,700 strike price. So you sold that put and then you bought the 5,650 as protection. You get $60 for that spread. And then let's say on the call side, same thing. You sell the 5,900, you buy the 5,950. That's going to create a little spread right there for $60. So your total spread, your total credit you're receiving is $120. And again, the only way to profit on that is if price stays in between 5,700 and 5,900. And you can do this on the next day expiration, so you don't have to worry about the PDT rule. And Iron Condors are really what I did to help grow my account, because you just have to make money on the stock or the indice doing nothing, which a lot of the time it doesn't really do much. And so why Iron Condors? They're range-bound markets. You don't have to really worry about direction. You just have to worry about volatility. As long as volatility is low, you're going to get that max profit. And because I like to do it on next days, because typically next day captures more premium because you have that overnight move. And you're getting all that overnight action. That options are just going to decay from 1 day to the next. And that's really why I love doing them overnight. And because it's double premium, you can get more premium while reducing your risk at the same time. You have a very wide profit zone if you do a very wide Iron Condor, and it's less monitoring. You can kind of set it overnight, just check the next morning. You don't have to worry about it the whole day. Now, the other spread or trade I would do is what is called a butterfly spread, okay? Now, this is either you only do it on the call side, you only do it on the put side, but essentially all you're doing is you're selling 2 5,800 calls. So let's say price is at 5,800. You're going to sell 2 calls at the 5,800 price point. And and you're going to buy one above it and then buy one below it. And so what you're doing is it's kind of similar to putting on an Iron Condor, except you can make a lot more profit with a lot less risk. So in this trade, you're only risking $100 and your max profit is $400. So you're risking $100 to make a maximum of $400. It's a pretty good risk reward. And the way it works is you basically need price to pin, and what that means is by the expiration, be at that price, at that 5,800 on that strike that you ended up selling. So if I sell these at 5,800, I want price to be as close to 5,800 as possible. Because again, you're selling these options. You want these options to basically be worthless. In order for that to happen, you need price to basically be at that expiration and closed entirely. So it's kind of like this payoff profile here where you start to lose money when it gets below 57.50. You start to lose money when it goes above 58.50. But anywhere in between, as it gets closer to that 5,800 mark, you're actually increasing your profits a lot. So if you ever believe that price is going to be neutral, stay kind of within a certain range, or pin using certain gamma measures, which is a more advanced tool, either way, you can still profit off that using the butterfly spread. Now, when would you want to use butterflies? Well, again, I don't use them that often. I said it was about 10% of the time I would use them. It's usually when I have high conviction on pin, when price is going to pin. So typically every Friday or at the end of the week, price or SPX likes to pin at whole numbers or half numbers. So 5,800, 5,850, those kind of levels. And it's whenever I believe, that price is going to be very neutral and not have any direction on it. So I'll get these because they'll have really high returns. I can have like a 25% win rate, 30% win rate, and still be profitable with this strategy. Very low risk. And it's also really good for earnings plays as well. So I talked about options, expiration pins, max pain every single week. But on earnings plays, it also can be pretty good on individual stocks as well. So that's another thing that I look to do. Now, position sizing. This is obviously the most important. If you only have a 10K account, you don't have too much to play with. It's not like you're dealing with 50K or 100K. So what I like to do is kind of separate it out into the actual strategies that I'm doing. So with the daily 0T spreads that I'm doing, I like to put about 6K of capital into them. Again, I'm not risking $6,000 per trade. Definitely not. I'm just putting that amount of capital into it, and I'll have my tighter stop losses in place. Next day, I'll typically hold these at 3K. Again, this is assuming I had a 10K account. And then butterfly is usually $1,000. It's kind of the max. This is actually a little bit more. I'll typically only go with like $100 or $50 trades with these as a max risk. Because again, you can make 2 times, 3 times your risk on those types of trades. So really, I would put this one a little bit lower, but this is a very simple position sizing framework you can use if you have $10,000 to trade with. Now, risk management, very simple. Never risk more than 2 to 5%. Now, you probably hear around that 1% to 2% is the golden rule. If you have a smaller account, 5K, 10K, I think you can really risk up to 5% and be okay, as long as you're very smart with your risk. It is more aggressive to risk $500 per trade on a 10K account for sure. But if you're only taking a few trades a week and you're being very responsible with your risk and you have a high win rate, then it could be okay. Now, if you're a little bit on the other side, you want to be more conservative, 2% is solid, 1% obviously better. You can put on more trades and use less capital. And so that's kind of the golden rule that I say, 2 to 5%, really depending on your risk tolerance. Now, when it comes to timing for when to enter these trades, the 0DTs I typically like to enter, I always sit out the first hour. The first hour is crazy, it's chaos. You don't want to do that. You want to let the market settle, pick a direction first. I typically actually like to get in these pretty later, like around 1 p.m., 12 in the afternoon, and exit typically at close, let them expire if it makes sense. The next day one, same thing. I like to enter these kind of late at the end of the day because really the first few hours of the market open, you just want to let it do its thing. Like I said, going back to that curve, how it starts to decay over time, right? Really towards the end of the day is when things decay. So it's not really worth getting into options right when the market opens. And I typically look for a lower VIX, trending on a range-bound price action, strong support resistance levels. And when to exit, I usually like to take profit on the credit spreads. If they're very far out of the money, I will typically just let them expire. Iron Condors, I like to take them at 50 to 75%. That way you're just locking in your gains. You don't have to worry about kind of the last power hour move or anything like that. Then cut losses, I'll typically have a 100% stop loss. So I'm getting a credit of $100. I'll typically stop out if I'm down $100. Sometimes I'll raise to $200 depending on if I believe the move is going to stay and end up in profit by the end of the day. But the golden rule is very simple. Don't let winners become losers, right? If I'm up 30%, 50%, 70%, move your stop to break even, take it. This is one of the biggest things I did that actually helped me become profitable a lot quicker because I had a lot of winners that I would just let lose over time. And so don't let your winners become losers. That is my golden rule. Now, realistic targets, 1 to 2% a week, $102 a week. I would lower this a little bit. 0.5% to 1% a week is typically pretty good. That's 20 to 40 bucks a day. Now, if you're able to compound this, you can start to get a lot higher. You can start making 21 grand a year, 10K to 21K. Again, you have to be a very good trader, be very disciplined, have a very good strategy in place with that. But it is possible. I've seen people do much bigger numbers than this. So that's kind of your target. And then final keys to success, start small. Okay, paper trade first, then risk 1 to 2% per trade. Don't need to start anything crazy. Just be consistent. Focus on getting small, consistent wins, $10, $20, $50, all you need, especially on a 10K account. That will stack up over time. Follow your rules if you have them. Take profits at X%, cut your losses at your stop loss, and protect your capital. Never risk more than 5%. Again, typically 1 to 2% is better, and boring is profitable. Selling options is boring, but it works. And if you simply do it, you can have consistency and become a professional trader. So hope you guys did enjoy this video. Feel free to subscribe down below. I'm putting out new videos like this every single week, and I'll see you all in the next video.